ownership for 75% for all. Some of the things we're offering is credit remediation, micro mortgage financing, down payment assistance, credit builder assistance, and aid with matching. We do have exciting news. Our gala is tomorrow, guys. Our gala is tomorrow. The time has come. If you have not already purchased your tickets, the information will be in the chat box for our MTTO family because we love you guys so much. It is still 75% off your ticket. Please get those tickets now. Tonight's topic is the lending process with our guest speaker, Ms. Debra. So without further ado, Ms. Debra.
Hello, everyone. My name is Debra Schlager. I am with Associated Bank. And let's see why my camera's not on. There we go. I'm with Associated Bank. I have been in the banking industry for over 42 years. How I want to do this tonight is I'm going to give you information about credit, about down payment assistance, because there is a lot of money that is available with grants, and plus it's limited. So I'm going to explain that. And also whatever questions, any questions that you have, please put it in the chat and let's answer the questions as we go along so you don't forget them. And anything that you want to know that you might have heard about the lending process and what you need to do to get a mortgage, please ask, because we want you to get into a home, and we sooner than later, because interest rates are going up and they're not going to come back down. But on the other side, it seems like home prices are going to start coming down instead of keep increasing. So they either get you in the interest rate where it's a lower interest rate, but then the purchase price is higher, or the purchase price is less and the interest rate is higher. So it's either way that that's how that works. So let's talk about the different kinds of mortgages. First of all, there are conventional mortgages, and there are FHA and VA, which are government insured mortgages. With an FHA and a VA loan, like I said, they're insured by the government. They have on FHA, they have a minimum requirement of 3.5% down payment. And you can buy a 1 to 4 unit building with an FHA loan. Still need 3.5% down on 1, 2, 3, or 4 units with FHA. FHA has to be owner occupied. So you cannot be an investor and buy an FHA loan. You have to live in the property. Also, with FHA, the minimum, we can go as low as 620 for a credit score, but not all, if you're shopping around, not all banks or mortgage brokers offer 620. If you're looking to get down payment assistance, any grants that are out there, you have to have a minimum credit score of a 640. So any grants, which we will discuss soon, you need a 640 credit score. Also with FHA, you have to pay private mortgage insurance. And private mortgage insurance is insurance that protects the lender if you went into foreclosure on the property. So if you had a 20% down payment, you wouldn't have to pay private mortgage insurance on conventional mortgages. And it protects the bank, like I said, if you go into foreclosure, this private insurance continues to make the payment while you're in the foreclosure process to the bank. FHA charges you the PMI regardless. It's a monthly fee, but they also calculate a percentage of what your principal balance is, and they add it on to the principal for the full 30 years of the loan. Now, FHA, like I said, it's a good tool if you buy 3 or 4 units because you only need a minimum of 3.5% down. But there's so many good programs out there for conventional mortgages with less money down and no private mortgage insurance. So FHA, I advise and I give people FHA mortgages if they've had a bankruptcy in the last 4 years. Because the rule is if you've had a bankruptcy in the last 4 years, the only mortgage that you can apply for would be an FHA loan, because FHA allows a bankruptcy as long as it's been discharged for a complete 2 years. They allow you to get an FHA mortgage, FHA. Conventional, if you had a bankruptcy, it has to be 4 years discharged, and you have to reestablish your credit on any bankruptcy. If it's conventional or FHA, you have to have credit reestablished also. Now, with conventional mortgages, there's programs out there where you can put 3% down payment and have no private mortgage insurance. My bank offers that, a 3% down payment, and that is on a single family home. On a 2-unit, different associations have different down payment. But if you wanted to buy owner occupied 2-unit building, I have a program where you can put 5% down and pay no private mortgage insurance. With that, you need a 640 credit score on single family condo or townhouse. On 2 units, you need a 670 credit score. Let's see, any questions yet? Am I going too fast? Okay. So with the conventional mortgages, like I said, you need a 640 credit score. If we do loans conventional with a lower credit score, we'll only go to a 620. But here's what happens. If you have a lower credit score, lower than 640, and you have to take a conventional mortgage, not one of the programs where there's no PMI, your private mortgage insurance is going to be sky high because of your credit score. So I wouldn't advise taking conventional.
Thank you for that information. I do have somebody that got a question.
Okay.
Mr. Ware said, what will disqualify you from an FHA loan?
What will disqualify you?
Yes, ma'am.
Nothing. It has to be owner occupied.
Interesting about
The FHA has to be owner occupied. So if you buy a multi-unit, you have to live in one unit and you can rent the other ones out, but you have to be owner occupied on an FHA loan.
Thank you so much for that answer. We do have a hand raised of Miss Tracy Gibson Jackson.
Hi, Tracy.
Hi, good evening, everyone. I apologize, I was a couple minutes late on the call, so I don't know if you talked about this yet, Deborah, or if you plan to, but can you talk a little bit about like what programs might be available for like down payment assistance or closing costs? I'm very interested in that.
Okay, so, well, since we'll talk about that and then I'll go back to about the conventional and FHA. So yes, there are grants available. There's grants available. My bank has a grant, and then there's also grants available depending on the counties you buy in, and they're all income driven. So any grant that is available, they look at your income. Now, my bank offers a grant of $4,000. It's forgiven at closing. It's free. You don't have to pay it back. $4,000, and it's for down payment. Now, to qualify for that $4,000, your income has to be 80% of the median income, and the median income is $69,000. But our bank doesn't take the whole family income. So the other grants that I'm going to discuss, they go by the whole family income. So if you have a husband and wife and one of them makes 69 or less and can qualify for the mortgage, you don't have to put the other person on the mortgage. They can go on just the title for the loan, because then you don't exceed the income limit. But any of the other grants that are available, they don't allow that. So if you have kids that live in your household, they're 18 years and older, and they work, they're going to have you fill out a paperwork asking, and the way they see it is on your tax returns. So if you show dependents that are dependent on you and it's on your tax returns, they're going to question that because we have to give the tax returns. This is for all the other grants, not the $4,000 that I have at my bank. And that applies on single family, condo, townhouse, and also on the 2-unit properties, the $4,000. We also offer $500 towards your closing cost. Now, everybody has to pay closing costs. I will get into that after I talk about the other grants about closing costs, because the seller can help with closing costs. With the other grants, the Federal Home Loan Bank has a grant. It is up to $6,000. Now, it's total family income that they look at. So if it's you and a husband, you might, and it depends on how many in your family, there's income limits. I know they just raised the income for one person family to 54,000. So if your income exceeds and you have more people in the family and they work, your income might exceed that you wouldn't be able to get that 6,000. Now, I offer that, the Federal Home Loan Bank, that's 6,000, but my bank, in order, because it's first come, first serve, and there's limited funds, and that has been out, that money has been out since January. So a lot of places have ran out of that money. So my bank allows, we can bundle, you can stack any of the grants on top of each other, but we don't give you the full 6,000, because if we're giving you $4,000 of our own grant, we give you 3,000 instead of the 6 to leave more money for other buyers. But still, that's $7,000 plus we give you $500 towards closing cost. There's another grant that just came out yesterday. It's called MMRP, Micro Market Recovery Program. It's with the city of Chicago. It's $15,000. You can use it on conventional or FHA. Again, it's income driven, but the 15,000 has very high limits. It's 120% of the median income. So much higher than the 80% of all the other grants that are available. And we can layer. So I've closed last year, the year before, people that got the $15,000 MMRP, they got the 4,000 from myself. They got the other 3,000. They only needed $1,000 of their own money for the down payment. Again, like I said, it's income driven. So there's also programs that you can qualify for first-time home buyer, and we consider first-time home buyer if you haven't owned in the last 3 years. So if you sold a property and you haven't owned another one in the last 3 years, we consider you a first-time home buyer again. With those programs, mostly all of them, again, are income driven. So the program that I have with the 3% down on 1 to 2 units, you can qualify 2 ways, either 80% of the median income, which, like I said, is mostly in Cook County is 69,000. Or if you buy in an area that's considered low to moderate income, it doesn't matter what your income is. Now, I know people always think, oh, low and moderate income areas, those are bad areas. Absolutely not. We go by the census tract, by the government census tract. So when those come out, and every time the census, they come out with it and they say, fill out your census so we can find out your income, that's the reason why. And I'll give you an example. I wrote a mortgage for a client that bought a 2-unit building in Wicker Park. The building was $550,000. Well, you can't have low income to qualify for a 550, but they were able to get the free down payment assistance that we had, plus get the program of 3% down with no PMI, because when I used the census tract, put in their address, it came back that that property was in a moderate census tract. So whatever address is, I mean, if you're looking and you have a real estate agent and you want to know, hey, I found this house, is it in a lower moderate area because of my income? All we have to do is look it up, and then we can tell you yes or no if you can qualify.
Thank you, Ms. Debra. I do have some questions in the chat.
Okay.
One of them from Mr. Chef Lee. There are 3 popular reasons you have been denied for an FHA loan: bad credit, high debt to income ratio, and overall insufficient money to cover the down payments and closing costs. Is this true?
Okay, honestly, no, because if the loan officer did their job, they would have never taken your loan application. They would have done a pre-approval or sent you to my turn to own. So they run your credits. We do soft credit pulls. And the difference between a hard pull and a soft pull, the reason we do a soft credit pull, it doesn't show up anywhere on your credit, nowhere. And now we can evaluate your credit report and tell you, okay, your score is low, but look at, you have a credit card with Capital One. Your limit is $1,000, but you owe 800. That's going to pull your score down because you owe almost to what your limit is. So we don't take applications. I mean, some people do, some loan officers, but in all my years in this business, I'm not going to take someone's loan application till I look at their credit report and advise them, okay, let's look at all your debt on the credit report. And if you keep all the debt, this is the only amount that you'll be able to qualify for. If you pay this down or pay this off, now I can give you a higher amount to qualify. And with the debt to income, that's what it includes. So we evaluate everything before we take an application. Because once I pull your credit, it's a hard pull. And every time somebody pulls your credit, it's going to make your score go down. And as far as that they deny you because insufficient money, first of all, if the loan officer knows what they're doing, they're going to tell you how much money you need up front for down payment, closing cost, before they even take the application. So if somebody were to call me and say, okay, I had my credit ran and this is my credit score and blah, 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 my middle score, because you get 3 scores and we go by the middle, not the highest, not the lowest, but the middle score. And you tell me this is my credit score, this is what I made on my W-2s, I'm not self-employed, I don't have self-employed income, so on and so forth. I can tell you, okay, this is what you're going to qualify for. So nobody should be taking a loan application and then denying you because your debt to income is too high. They should know all of this before you even sign a contract and when they're talking with you.
Thank you. We have another question. Can you help people with Section 8?
Okay, so absolutely. The City of Chicago, the Chicago Housing Authority Choose to Own program. I am on the list as a preferred lender with them, but you have to be approved with Section 8 and go through their class, their home buying class, and get approved to use your voucher to now purchase a home. So I know because I train people on their classes that they have with Charnice, who's does the housing counseling. You have to, I know, have $2,000 minimum in a bank account. But because you need for earnest money, you need for a home inspection, but you have to take their class. She has to get all of your paperwork, and then she will advise you yes or no if you qualify, and you get sent to one of the approved non-for-profits that they deal with, which is NHS and YWCA. Once you meet the counselor, they take all your information, they give you the eligibility paperwork, and then they tell you, okay, here's the list of lenders that you can call and see what programs they have. So absolutely, we do Section 8.
Thank you for that. And the other question is, how do you buy a house with no money out of pocket?
Well, you need some money. You can't, I mean, you can get grants to help you. You can get the seller to pay, because it is legal to get the seller to pay, give you a closing cost credit, and it's built in. Usually the real estate agent will negotiate it into the sales price of the house. So if there's a house and it's listed for 110 and you offer 100,000 and you want $3,000 in closing cost credit, the realtor is going to say they won't take less than 100, and you want 3,000. So you're going to offer 103. The seller's going to, and the real estate agent is going to put $3,000 closing cost credit from the seller. But you still have to have money. You still have to have a down payment. And the listing agent, when you make an offer on a contract, you're going to have to put at least $1,000 for earnest money to show in good faith that you're going to purchase that home. So I know you're probably talking about those things that come on in the middle of the night when you can't sleep about, I bought this house and I didn't have any money. And those days of those scams, they're far and few between. or where somebody has a property and they hold the contract for you. They give you a really high interest rate, but you don't have to go to the bank and you can pay the owner directly. They're going to charge you a much higher interest rate than what is out and available today.
Thank you,
Yes,
Ms.
thank you.
Deborah.
Mhm.
I believe that was all the questions. Ms. Mobo, were you gonna say anything?
Yes, I was gonna ask, can you go back to the different type of loans that we
Okay.
can qualify for?
Okay, so it says, is it good to apply for a zero down VA or USDA loan? USDA loan are the agricultural loans, so you have to buy a lot of land on the USDA loans. That's not usually in Chicago. Those are out in the suburbs. And a VA loan, so here's the thing with VA. Yes, it's no money down, but the VA charges you a VA funding fee. And it could be anywhere, depending on your eligibility, it could be anywhere from 1.5% to 3.5% of the loan amount. So if you can get grants on conventional mortgages, they might not have them on all the FHA or VA loans, but if you can get a grant and put money down, I would advise to get the grant and put the money down, because yeah, you can buy, like I said, VA with no money down, but they're going to charge you that VA funding fee. And you can either pay it up front or you can add it on to the principal of the loan. So if it's $4,000, you're just financing $4,000 for 30 years, especially in today's market with interest rates at 5.75. I wouldn't advise it. I would take a conventional and get the free down payment assistance. Anybody? No other questions? Okay, so.
That's it for now.
Okay, do you guys have any questions? Anything you want me to address? Any questions that come through when you're sitting with the buyers? How about on credit?
Yes.
Go ahead.
Yes, we do have that question on credit. What is the required credit score that they need in order to qualify for these loans?
Okay, so to get any free money, any grants, the minimum credit score is a 640. And it's very easy. I know people tell you, oh, everybody has a different opinion, because somebody might have bought a house 30 years ago and our parents tell us, oh, well, when I bought a house, but everything changes every day. The guidelines, the rules, COVID, they were very strict, not that much anymore, because people are back to work or don't want to go back to work, but there's still jobs available. You need at least a 640 credit score. Now, it's very important to not have anybody keep pulling your credit, no matter what they tell you, because the more times they pull, that's a hard credit pull. It brings down your score. And also, if you have your soft credit pull, that can be evaluated. So say I had a client today, I tried to explain to her, pay down $2,700 in debt, which frees up $230 a month that can help you qualify from like 117 to all the way to 160,000 by just paying off $2,700. That's a huge difference, because as we know, it's very tough to find properties in Chicago or even in the burbs, anything under 160. That is very, very hard. At least something that's livable, you don't have to do a lot of work to. So if we can show you here's a trick. If you have a credit card and say it's almost maxed out, that's going to bring your credit score down. But you can call that creditor. Let's say it's Capital One, because I know Capital One does this. If you called Capital One and you have a credit card with them and you've never asked for a credit increase, a line of a credit card increase, Capital One, as long as you ask them, make sure you ask them and say, now you're not going to do a hard credit pull. Capital One will increase your score. Increase your credit line. So let's say your credit line is $500 and you owe $400. Your score is going to drop because you owe almost to what the limit is. But if you call them and say, listen, I've had this credit card for 2 years, you've never given me an increase. Can I get an increase without you doing a hard pull on my credit? You don't need to tell them you're buying a house, but tell them without doing a hard pull, can I get an increase? Maybe $500. So double. If they give you a $500 increase, now your limit's 1,000 and you owed 400, your score is going to go up because you have that much difference of what you owe to what the limit is. But you need to call the creditors to ask them if they do a hard pull. Because if you keep increasing and everybody does a hard pull, that's going to hurt your credit also. Let's see.
We do have another question. What is some fast ways to make money for a house from your experience with many people in this career?
Okay, so don't buy the most expensive on the block and don't buy the cheapest. Buy the middle, and don't go into a house looking at the paint, the carpet, even the paneling, the bathroom with the pink tile and the blue tile. As long as the bones of that house are good and you can get it because it's not remodeled, that is what I would advise you to do. You can always remodel. You can always remodel. I have a townhouse in one of the suburbs in Hanover Park. And it used to be my son's, and then he had it for a year and decided to go chase who's now his wife, and said, here, if you give me some money so I can go to another state, you can have my townhouse. How very dumb of him, because I did it, of course, because I made out. That townhouse has increased in value by over 100,000. And this was in 2000. He did this in 2015. So in 7 years, it's increased by 100. But it was ugly. Everything was original in it, and it was ugly. So little by little, I started remodeling. I put in new lights. That's another thing, light fixtures. People walk in a house and you see the ugly light fixtures and they're like, oh my God, these light fixtures. There's so many. You can go to Facebook Marketplace and you can buy light fixtures. There's Habitat for Humanity, that they own a store. It's called Restore, and they have all kinds of houseware stuff, building and house stuff that builders, that some of it is brand new, that they give to them, that they donate. People, when they remodel their houses, they donate their old stuff. You can find really good items to remodel your house. So don't look at it's ugly inside, or even it's ugly outside, because you can paint brick. So if your brick is ugly, you can paint everything. I have friends that painted their ugly siding on their house because it was like a yellow or some color. They painted it gray, painted the door. It looks like a totally different house. So don't buy the most expensive. Look beyond that. You have to redo everything. You can do it little by little. That is going to build you huge equity.
Thank you. Miss Tracy Gibson Jackson does have a question. Miss Jackson.
Tracy?
Hi, Deborah, can you talk a little bit in terms of timeline? So, okay, you get approved for a loan, and what, how much time do you have? I think I remember somebody
like
90
documents
days,
expiring. Yes.
Like,
so,
yeah, like if you're trying to look but haven't found anything, like what is that? How much?
So your credit score. So here's your credit. Your credit is good for 120 days. Then we have to re-pull your credit again, because they're good for 120 days. As far as your other documents that we get, like your paycheck stubs, because we ask for the most current 30-day paycheck stubs. We ask for the most current 2 months bank statements. Your tax returns, we ask for the last 2 years tax returns, but we already have your tax returns and it's not an end of the year. So the only thing that really we would have to re-pull is your credit, because like I said, it's good for 120 days. And okay, unless you got a raise, and and that we wanted more income to get you approved for a higher amount, then I would say, okay, give me your new pay stubs so I can calculate how much your rate or your increase is.
Okay, so one would want to avoid the going past 120 days, because that would be another hard pull, right?
It will be another hard pull. But also, let's keep this in mind. If you find something and you're 90 days in and you sign a contract, but we're not going to close for 45 more days, we're going to have to do another credit pull, because now that was only good for 120. You're at 90. That's
Okay.
only 30 days, and you got another 15 days.
Okay.
So we're going to have to do another credit pull.
Okay, thank you.
Mm-hmm.
Thank you, Ms. Deborah. I got another question from Ms. Williams. What percent should your DTI ratio be?
Okay, so different programs have different debt to income. So let's talk about the conventional, the program that I have, because it is a great, great program with no PMI, because like I explained, if you have to pay PMI on a conventional loan, if you don't have higher than a 720, let me tell you this, 720 credit score, that PMI on a conventional mortgage is going to be sky high. It's not worth it to take a conventional. It would be worth it to take an FHA loan, because the PMI qualifications are much less. Okay. Now, debt to income. How we figure the top debt to income ratio is the principal and interest, the real estate taxes, and the homeowner's insurance. And if you have to pay PMI insurance, that is, we take that and we take your gross monthly income. We don't go by net, we go by gross. Usually the top ratio needs to be 37%. Now, the back end ratio, I'm going to explain with the program that I have. The back end ratio cannot be higher than 47. Now, conventional, if you take PMI, in the industry is 50% on the back end ratio. So we could go up to 50 on a conventional, but you would have to take PMI. So the program that I have with the no PMI, the back end ratio cannot be higher than 47. But let's think about what's included in the back end ratio. It's installment loans. If you have any installment loans, car loan, any other personal loan that's an installment, if you have 10 months or less, we don't count that into your back end ratio, because it's 10 months or less, we don't have to include that. And then I'm going to talk about student loans in a minute, because that is really, that's tough for people to get approved with student loans. If you have revolving debt, we have to count what those payments are. When we look at student loan debt, different government looks at it differently than conventional. So FHA and VA look at student loans. If you're in forbearance, in deferment, which deferment means that you're still in school, or forbearance, you don't have to pay yet, because during COVID, they put everybody in forbearance and you didn't have to pay. If there's no amount on your credit report for your student loan, FHA takes whatever the principal amount is, and we figure your payment at 50% of whatever the principal is on all of your student loan debt. Now, conventional will allow income-based repayment. So they will not allow, conventional will not allow forbearance or the deferment either. You have to have a payment on the credit report, or give us a letter from whichever agency it is stating this is what your monthly payment is. If you don't have that, not income-based, but if you don't have that, then we have to take 1% of the principal balance as your monthly payment on a student loan. But if you have income-based, you can, on conventional only, we will take income-based. And it's very tough, because a lot of people have student loan debt, and some of them have $60,000, $70,000, $100,000. And it's tough. It's very tough to get approved with that high debt. Let's see. I see a question. How can I get help with housing in Illinois? I don't know, websites that help with understanding the housing. Okay, so we have these calls every Wednesday, but also in order to get the down payment assistance and the first time home buyer, the grants and also the programs, you have to attend a home buying seminar with the non-for-profit agency. And they explain everything, but they don't just stop. Like with My Turn to Own, once you go through the agency, you get your certificate, you close on your house, it doesn't stop there. They continue to help you make sure that you're on a budget, make sure that you haven't gotten in trouble if you need help with anything, because once you close on a house, there's a lot of grants and help with the city of Chicago. They have a roof and porch where if you need money, it's a lottery, but the city does give out money for repairs. So there is a lot that is available once you close also. Let's see, I have a question. I have debts that no longer on my credit report. How is that looked upon when trying to buy a home? Okay, so I don't understand that the debt is not on your credit report or you have a zero balance, because I wouldn't close out. Oh, wait, before we get to that, here's a big thing. If you have collections, do not, whoever tells you that you should pay off your collections, do not pay off any collections. Because first of all, when we take your information and we run you through the system, we run you through this program, and it gives us an automated approval, yes or no, if it approves you. It always will state on there, yes or no, if you have to pay off the debt. This is unconventional.
So
Again.
that's not, I'm sorry, how you doing, Deborah? That's my question. I have, back in when I was in school, how we all got into credit card debt, because it was so many years ago. It was, I never declared bankruptcy or anything, but it's no longer on my credit report. My credit score is currently a decent, around a 727, between about 745 when I check it on Credit
Wow,
Karma.
that's an excellent score. Yes.
So my question is pretty much how is that unresolved debt from various credit cards back in the day that's no longer in my credit report? Is that looked upon?
It went away. So if it's no longer there, it just dropped off because they're so old.
Okay.
So did you have your credit pulled with your FICO score or Credit Karma?
Credit Karma, but also I checked with what's the Bank of America credit check. I haven't done the free once a year free credit check with the 3 major credit bureaus. I know that Credit Karma is not as accurate.
No, Credit Karma is not FICO. So that's not what we use. That's not for mortgages. Credit Karma, those scores are for credit lines, cars, credit cards. You can have My Turn to Own. You can have them do the soft credit pull and it'll tell you. But if it's not on there, they dropped off.
I'm sorry, Ms. Deborah. We do have Ms. Gibson Jackson who had her hand raised. Ms. Jackson, I'm sorry, you can go ahead.
I just have 2 quick questions. The program that you mentioned, Porch to Roof, like how do we find out more information about those?
That comes out, it's not available now because it's only certain, I forget what months it is, maybe October. That is not available at the moment.
Okay.
But once you own the home, like I said, the non-for-profits and My Turn to Own, they continue to give you information. They continue to check in on you. So you're not just forgotten, like, okay, thanks for coming through our company and goodbye. Not at all.
And then my other question is, because I've been trying to figure this out, like the credit bureaus, the scores, like the 3 of them, like one tells me like 710, one tells me 701. Which one is true? Like, because all 3 of them say, like, which one do we go by? Or does
the middle, not the highest, not the lowest, but the middle score. That's what we use to determine your credit score. So the
Okay.
3 scores you get, we go with the middle score on them.
Okay.
And
Thank
if you apply with someone else, like there's a spouse or 2 people, whoever, when we determine rate programs, if you qualify, we go by whoever has the lower of the credit score. So if there's more than 2 people or 2 people, whoever has the lower of the credit score, that's the score we use.
Okay.
Plus, like I said, there are a lot of resources that are out there. If you buy a bungalow, there's the Bungalow Association, and they have all kinds of grants also available to fix up your home. Again, these grants, a lot of them are like lottery. So you have to apply and hope that they pick you or there's money left. But there are grants out there for repairs once you own the home.
Is there like a grant database? Because I feel like, some we hear about from My Turn On, but like, how do you keep
a grant? They don't have the database. You just have to Google,
Okay.
grant, City of Chicago, home remodeling or home repair grants, and they'll come up.
Thank you.
And also attend the home buying seminars that are out there. A lot of places have home buying seminars. We're all going to be in one at Malcolm X College next, not this weekend, next weekend. Most of them are free, and there's lots of information. And it's not just lenders, it's insurance companies, it's home inspectors, it's the non-for-profits, the the housing specialist. They're very useful and resourceful, and they give you a lot of information. Any other
Oh, thank you so
questions?
much. Yes, we do have another question.
Mhm.
So, say for instance, someone has the income, but their credit is not that good, and the other person has good credit, but they don't have the income. Can they both go into a home loan together?
So here's the thing, the first and foremost would be your credit score. So if you don't qualify and have the minimum 640 score, you're going to have to you're going to not be able to use that person. But if you live together, so you have to show relationship. So it's allowable. It's usually called border income. But so say it's a husband and wife, but we can show that they contribute. You have a checking account together. Let's just say it's a relationship, and you have a checking account together. You both deposit into the checking account. It's in both your names. We can show your direct deposit of your paycheck. You pay the bills out of that. We can use 30% of the person that's not going on the mortgage because of their credit score. We can use 30% of their income to help you qualify. But again, we have to show the relationship, and we have to show that it truly is, that they contribute and you have something in common. But yes, we can use 30% of their income. So if it's you and one of your kids and they're just going to move back to help you, that's not going to work. We have to show that the relationship and they've been contributing, and we can use 30% of that income to help you to qualify.
Okay, so what if, thank you for that answer, first of all.
Mhm.
What if it's like just a relationship that was just started, maybe a boyfriend and girlfriend or something like that, and you get, I guess, a credit, well, if you guys get some type of bank account together and things like that, then that can still qualify?
Yes, but here's the thing. If you just did it in the last 6 months, no, because they're going to want to see the relationship. Are you both on the lease? How have you been contributing to the expenses? That's what they look for. That you both have been contributing, not that the person moved in or they're on your documentation. So to help you qualify for the loan. Yeah, I mean, you can have a parent co-sign for you, but here's the thing. If you're a first-time home buyer and you have a parent or anybody co-sign, you're not going to be eligible for the free money or the free programs for first-time home buyer, because they already own a house, your parents, and they're not going to be living in the property. So with these programs, they all have, and the grants, they have to be owner occupied. So the city of Chicago has a $15,000 grant. It's called MMRP. Like I said, it came out yesterday. They're very strict. You have to live in the property, and it's a silent lien. It's a silent mortgage that is put on the property for 5 years. You can't sell that property for 5 years. Now, if you decide to sell it after 3 years, they're going to prorate how much you have to pay back of that $15,000. But I have a client that had a loan like that. They got the $15,000. The property increased so much with the equity that she didn't have to pay that much back out of the $15,000. So she found out what she would have to pay, and she sold the property and still made a lot of money because of the equity on that house.
Thank you so much for that information. Also, we do have a question. Can you put the information for the Malcolm X event in the chat, or do you have that information available?
No, but I can look it up. Yeah, I can look it up. Yes.
So
I'm telling you, that would be a good event to go to. I've been in the event every year since they've had it, except during COVID, the last 2 years. And the one non-for-profit that attends, that hosts it, they will pull your credit, soft credit pull right on the spot. So they have their computers, their laptops, they will pull that credit right on the spot. Plus they give away all kinds of raffles. They raffle off all kinds of stuff over there. Every table has free giveaway things. And they have different, you go into different rooms, and they explain different products and the whole home buying process. And I think they give you lunch and stuff, because I know it's usually an all-day affair. But yeah, it's very good. Very good. You get a lot of education. And like I said, there's home inspectors, because when you purchase a home, you should, once you go through the whole process, you got a pre-approval. Now you work with the real estate agent. You have to have a home inspection. No matter what anybody tells you, you have to have a home inspection, because there's hidden things that you can't see, like a crack in your foundation. That is huge. Or your house could be falling into the ground. Literally, the foundation could be crumbling. Home inspections, you need to have them. You could have termites. It sounds crazy, but there are still termites, and you can't see them, but the home inspector can see the tunnels. I had somebody who bought a house in the city of Chicago. They had to knock down the whole inside, all the 2x4s, everything, and start over because the termites ate away at the inside the wood, the 2x4s. So you have to have a home inspection. Also another, when the real estate agents negotiate a contract, like I had said earlier, you can negotiate and get the seller to pay closing costs. Again, it's going to be built into your purchase price. So if you know that you need closing costs, because usually it's around 3% of the sales price for closing costs. Now, the biggest thing for closing costs, when you buy a house in the city of Chicago, they charge you a city transfer stamp. And it's $7.50 per thousand on the whole purchase price. There's no way of getting around it. That is a buyer's charge. So when you have a large sales price, that is a lot of money. You're going to pay a title fee. We don't get to pick. The buyer does not get to pick the title company. The seller picks the title company. So the fees, what they charge for that title company and for that title, that is from the seller. So like I said, you can ask the seller to pay closing costs. It's built into the contract, into your purchase price. Home warranties. Usually after you do a home inspection, if there's a bidding, let's use this for example. Say you're bidding on a house and there's bidding wars because everybody wants this house, but you came in with the highest and the best, and you didn't ask for any closing costs, and you didn't ask for a home warranty. And usually the real estate agent will not ask for anything because they know once you do a home inspection, usually they find something that needs to be repaired. The furnace might be old. They might say the roof is going to need, you're going to need a new roof in 2 years. The hot water tank is on its last legs. So once you get, because you're going to go to that home inspection with your real estate agent and the home inspector, and usually on a single family home, you're there for 2 hours and they're going to point out everything. And then they're going to give you the home inspection. They're going to email it to you, color pictures, everything, telling you what needs to be done, the age, what they think you have to do to that property. Then it gets negotiated between the attorneys. Let's just say they said the hot water tank and the roof. Well, there's no way a seller is going to replace that before they sell the property. So they might come back and say, okay, we'll give you a closing cost credit of $5,000. That's how you can get your closing cost credit, because like I said, if you're in a bidding war, they're not going to take your contract when you're asking for money. They're going to look for somebody who's got the highest and best and is not asking for anything. That's then when you ask for whatever the repairs, you ask for the cash. Also a home warranty. Usually then the real estate agent will ask for a home warranty. I would advise to get a home warranty. I have a home warranty on my rental and my hot water tank went out. Those home warranties, they're usually around $500 or $600. After the closing, you can call the home warranty company and you can upgrade. So everything is covered. You can upgrade it. You can pay monthly after, because they're good for 1 year. And then you can pay monthly. But my hot water tank went out at my house. I had to pay the deductible. It's $100 deductible every time they come out, what you call them for. I paid $100. I got a brand new hot water tank. There's no way that it would cost me $100 to replace and have somebody come out. And if you call a service person to come and repair or replace anything, it's well over $100. Let's see. Can I open a credit bank account myself without my credit score being pulled? And what is the best way to start a banking card on building my score? No, any credit bank account. So if whatever you open that is giving you credit, they're going to do a credit pull, because that's the only way they know if they can lend you money and if you're going to pay it back. And
What's the question?
hello, Don.
Hey, what's going on? How y'all feeling? Happy Wednesday. I want to tap into that question. What exactly was he asking, or she?
Can I open a credit bank account myself without my credit score being pulled? And what is the best way to start a banking card on building my score?
Banking card. Okay, cool. I'm gonna follow up after you. Go ahead, Ms. Debra.
Well, you know, here's a couple tricks too. If you have family, parents, whatever, they have good credit and they have credit cards and you want to buy right away, but you don't have enough credit, because we look for 4 credit trade lines. Okay. And credit trade lines are 4 lines of credit cards, to show that you pay on time. That's what we look for 12 months. If you don't have any credit, no credit score, we can use alternative credit. Now, alternative credit is, the first is rental. We look to see, we ask for 12 months, or we send a verification of rent to the landlord. You can use utility bills. You can use car insurance as long as it's paid monthly. You can use cell phone bills because you pay those monthly. Now, if you have family, my son was buying a property and he needed to raise his credit score. So his dad put him on his credit card. Now, mind you, you don't want to be authorized user, because an authorized user does nothing for you. It just means that you're authorized to use that person's card. You can charge it all you want, but you're not liable for those payments. So don't go as an authorized user. You wouldn't want to go on there as a co-owner. So my son went on his dad's credit card. It raised his score by 100 points. But you have to ask the question, what is the balance and what do you owe? Because I have a client that he said, yes, my sister's putting me on her account. Well, he should have asked the question. I asked him, he goes, no, she doesn't owe anything. The limit was 500 and she owed 480. So we already know what that did to his credit that was low to begin with. It made it lower because she owed almost to what the limit was. But if you have family or friends that are willing to help you so you can get into a home right away, that is a trick of the trade that you could do that. It'll give you a credit score, boost it, and you'll be able to buy right away.
Well, thank you so much, Ms. Deborah. We really appreciate your time and you answering these questions for us. We always love when you're on and you give also this great information. Thank you everyone for being here with us tonight on this Wealthy Wednesday. Please remember that we are having a gala tomorrow at 6 o'clock, and that will be at the South Shore Cultural Center. It's not too late to get tickets, so please get your tickets now or as soon as you possibly can. And we really appreciate you all being here. So until next time, everyone have a great night.
Good night, everybody.
Good night.